Okay, so welcome everybody. Good afternoon. Welcome to Mace Live, hosted by Mace and Associates. We are in our fourth class this week, and if it is the first time you've joined us, welcome. If you were here on Monday or this morning, welcome back. I am Catherine Yuan. I am one of the partners with Mason Associates, and I will be your moderator today. Many of you have heard about Mason Associates. If you have not, we are a full-service CPA firm offering services in accounting, auditing, information technology, and tax. I am going to go over a few housekeeping items before I turn over the screen to our speaker, Amy, today. If you are encountering difficulties in using Zoom, please use the chat function to get help. In the chat function, where we have already shared a link to where you can download the PowerPoint used in this presentation. If you need any assistance, please let us know through the chat. During the presentation, if you have any questions for the speakers, please use the Q&A function. The speaker will answer some of the questions during the presentation and defer the rest of the questions till the end of the presentation. Please keep in mind that this session is being recorded. So if you prefer, you can ask your questions anonymously. There is a box in the Q&A function you can check anonymous. Then finally, there are 4 polling questions during this presentation. In order to get the CPE credits for this class, please answer the polling questions. It doesn't matter if you get the answer correctly. All you have to do is participate. So please, if you cannot, for whatever reason, see the polling questions or put in your answer, please let us know through the chat function and we will make sure to give you credit for that particular response. When you exit the Zoom presentation, it will redirect you to a survey. Please fill out the survey so that we can send you the CPE certificate. The CPE certificate will be sent to you by the end of this week. So if you were in an earlier session and have filled out your survey but have not gotten the CPE certificate yet, it will still come to you. For whatever reason, if the Zoom did not do not direct you to the survey, please let us know and we can send you the link. The survey's link is essentially the same for every class. So if you have one for the previous class, you can use the same link and just make sure you answer the questions accordingly. And the recording of this class will be available soon. By the end of the week, after we finish the entire week of Mace Live, we are going to compile one email and send to you with the links to all 6 of the classes. Now, I would like to introduce you to our speaker today, Amy Meyer. Amy is one of the partners at Mason Associates. She's a California CPA who has been with the firm for 26 years and has focused on municipal and special district audits throughout her career. She has also been involved with a number of accounting and GASB implementation training classes customized to our clients' needs. Amy is a past chair of the Governmental Accounting and Audit Committee of the California Society of Certified Public Accountants and continue to serve on that committee, which provides practical guidance to CPAs in the area of governmental accounting and auditing in an effort to improve the quality of financial reporting of governmental entities. The committee, along with the California Committee on Municipal Accounting, also issues white papers offering guidance on California's specific implementation issues to CPA firms and governmental entities, such as the recent white papers related to the implementation of GASB 75 and also GASB 84. With that, Amy, welcome and thank you for teaching the class today. It's off to you.
All right. Thank you, Catherine. Hi, everyone. Good afternoon. So I'm going to start here, and apparently my slides don't want to go forward. There we go. All right, so you know who I am. You see my old photo there. So the GASB pronouncements we're going to discuss today, as Catherine mentioned, include fiduciary activities and leases. So June 30, 2021 is when fiduciary activities statement, or statement 84, is required to be implemented. Of course, you can decide whether you want to early implement. That's up to each of you to decide. And you may realize that, that the implementation date has been deferred by 1 year based on GASB 95 that was issued, I believe, back in May, that extended the implementation date, because this statement was supposed to be implemented in fiscal year 2020, or this year. So this is fiduciary activities. We have Statement 84, which has already been amended with Statement 97. Statement 97 was just recently issued in June, and there are 2 paragraphs of that statement that are effective immediately because they impact Statement 84. So that's something that you want to keep in mind, and we'll go over it a little bit on some later slides. The rest of GASB 97 is effective in fiscal year 22. And then also for fiduciary activities, you have Implementation Guide 2019-2, really good resource for going over those Q&As that help you figure out how to implement and how specific situations apply to your entity and how to report them, whether or not they're fiduciary activities, and how to report them in the financial statements. So the other statement we're going to talk about later in the presentation is leases, which that is now applicable in 2022. So some of you may over the years may have seen my presentations related to fiduciary activities and leases back when it was a little more critical. They were, implementation was pending, but now those have been deferred a little bit, so they're not as critical now. So leases is based on GASB Statement 87, and then there's also an implementation guide for leases 2019-3. Then also GASB Statement 92, which is an omnibus statement, or one of those kitchen sink statements that GASB issues, and that contains a few provisions specific to 84 and 87, so both fiduciary and leases. So that's why if you've ever heard me say, rather than you look to a GASB statement, you should always think of looking to the GASB codification, because it includes all subsequent statements that amend a particular area. So you want to go to the GASB codification for leases, not just Statement 87, because it's already been amended, and same with 84. So for those of you with a calendar year end, your implementation dates for fiduciary activities is this calendar year. So you don't get that 1 year lag anymore. So that is due this year. So you're halfway through that fiscal year. So you should be figuring out what needs to be done this year. And then for leases, it's December 31, 2022. Now remember, both of these statements, 84 and 87, require restatement for the beginning balances. So that's why it's important to start this process now. So first, fiduciary activities. And as Catherine mentioned, any questions you have along the way, I'll be happy to answer. If something gets too involved, we might defer it to the end, but if they're straightforward questions we can answer along the way, I'd rather do it as we go along, so it's on the slide we're on. So the key discussion points that we're going to talk about identifying the fiduciary activities. What makes something a fiduciary activity or not? And then reporting fiduciary activities and fiduciary funds. I'm going to say the word fiduciary about 750 times, if not more today. You'll get tired of the word fiduciary and leases, as I already am. And then Statement 97, we'll talk about those paragraphs 4 and 5 that are required to be implemented immediately. So those you don't defer until fiscal 21. And then implementation guide implementation of GASB 84. We're going to talk about the CCMA white paper. I'll go over that because it does have some really good information for you related to implementation. So how do you identify fiduciary activities? So you start, there are 2 types of fiduciary activities. There are component unit fiduciary activities, and then all other. So if an activity is a component unit is a fiduciary activity if it meets the criteria set forth in GASB 14, Statement 14 to be considered a component unit, and the criteria in paragraphs 6 to 9 of Statement 84. And then other activities are fiduciary if they meet the criteria in paragraph 11. Paragraphs 10 or 11. It's not an and. So fiduciary component units, again, it's that they meet the criteria in Statement 14 as amended, again, you'd want to look at the codification to figure out whether those criteria to determine whether something is a component unit or not, because the codification will include all the amendments. So it's a component unit is a fiduciary activity if it is one of the following arrangements: a pension plan that's administered through a trust, an OPEB plan administered through a trust, assets from entities that are not part of the reporting entity that are accumulated for pensions or OPEB, and using those criteria that are in Statement 73 or 74. And then pension or OPEB plans are component units if the primary government has a financial burden if it is legally obligated or has assumed the obligation to make contributions to the plan. Now, this is the one paragraph in Statement 84 that has been, I don't know if you would call it clarified or amended through Statement 97. Statement 97 says the financial burden is applicable only to defined benefit plans, defined benefit pension or OPEB plans that meet the trust criteria. So Statement 84 just says pension or OPEB. Statement 97 amends that to mean defined benefit pension or OPEB plans, not defined contribution plans. So a component unit that is not a pension or OPEB arrangement is a fiduciary activity if the assets have one or more of the following characteristics. So this is that all other component units. If they have, and so there's 3 slides, there are 3 criteria that they have to meet all 3. So it's that the assets are administered through a trust or equivalent arrangement in which the government is not the beneficiary, dedicated to providing benefits to recipients in accordance with the benefit terms, and then legally protected from the creditors of the government. So that's one of the main that, so it's a little confusing because it's 3 criteria and number 1 has 3 components to it. So I know that can be a little confusing. And you all know I talk with my hands all the time. So if I'm covering, just, you can tell Catherine to tell me to stop because I can't not talk without my hands. So, so the step 2 is that the assets are for the benefit of the individuals and the government does not have administrative involvement. So what's administrative involvement? That includes monitoring compliance with requirements established by the government. So if the government is responsible, if you are responsible for monitoring compliance for the use of those assets, then it's not considered a fiduciary activity. It becomes your activity that gets reported in whatever governmental or enterprise fund that's applicable, and not fiduciary. If the government determines eligible expenditures or has the ability to exercise discretion over how the assets are allocated, or has direct financial involvement with the assets, such as matching resources. So if any of those criteria, that means the government has administrative involvement, and so it would not meet this criteria under step 2, so it would not be considered a fiduciary activity. And then the third component is that the assets are for the benefit of organizations or other governments that are not part of the financial reporting entity of the government. And the assets are not derived from the government's own provision of goods or services to those organizations or other governments. So it's not something that you're doing. You're only holding those assets on behalf of the other entity. You're not involved with creating those assets. So any pension or OPEB arrangements that are not component units, those could happen, they might be fiduciary activities if the government controls the asset of the arrangement. So if the trust assets are from other entities that are not part of the reporting entity, it's kind of your easiest example if you're responsible for holding those assets on behalf of other entities, or you have the ability to direct the use or exchange or employment of the assets, so making those benefit payments to the recipients. So restrictions from legal or other external, so any restrictions from legal or other external restraints that stipulate the assets can be used only for a specific purpose do not negate your control of the assets. So you have to really do that. Control is that key point of whether you control the assets to figure out whether it's fiduciary or not fiduciary. Control becomes very important. And you have to read that paragraph in GASB 84 a number of times to kind of get the nuance of it. So other fiduciary activities, so anything that's not pension or OPEB, those employment benefit type plans or component unit that are not component units, are considered other fiduciary activities. So you do have those situations, like things that are currently in some of, I'm going to say some of, because we'll talk about agency funds in a bit, but some of those things that are in your agency funds now are considered other fiduciary activities. You're holding those assets on behalf of another entity. You have no control over it. It's not a component unit. So it falls into this other category of other fiduciary activities. So in order to be in that, considered a fiduciary activity, you have to meet all three of these criteria that are on this slide and the next slide. So the assets are controlled by the government. So you are controlling the assets, holding the cash, writing the checks, dealing with the assets. The assets are not derived from the government's own source revenue, so it can't be your revenue that you're putting off to the side for someone else. It has to be a third party or that other entity's revenue. And the government, it can't be a mandated non-exchange transaction or a voluntary transaction, except for pass-through grants for which the government does not have administrative involvement or direct financial involvement. Some pass-through grants where you're passing it through to another agency may qualify, may not, the assets may still qualify to be fiduciary activities. And then the third criteria that it has to meet, and this one gets a little tiny. I try to keep the slides a little uncluttered, but I figured since they're in front of your face that we can get away with a little more of that these days. But they have to meet all three of, then in the third criteria, the assets have to have one or more of the following three characteristics. Again, GASB keeps layering these threes upon threes. So all three of, this is the third of the original all three, and then within this third component has to meet one or more of the following characteristics. So be administered through a trust in which the government is not a beneficiary, with those assets being dedicated to providing the benefits in accordance with the benefit terms, and legally protected from the creditors of the government. And then be for the benefit of individuals, or the government does not have administrative involvement. Again, remember that definition of administrative involvement. The government can't have administrative involvement over those assets or direct financial involvement. And then be for the benefit of organizations or other governments that are not part of the financial reporting entity.
Amy?
Yes.
There's a question.
Okay.
Can you give examples that are common to these criteria? For instance, if a city uses a third-party trust administrator, is it a fiduciary activity or a component unit?
So it depends on, I assume you're talking about for a pension or OPEB plan. We're going to go over that in details in a few slides, but you have to look at the plan as a whole. This is one of the interesting things, that trust administrator, if it's your own trust the government has established on its own, then it could be a fiduciary activity depending on what the use of the assets is. If the assets are for the benefit of third parties, nothing to do with the government, then it might be fiduciary, a fiduciary activity. Easy examples, I mean, I keep getting pension and OPEB in my head. You know, you can't get beyond those pension or OPEB examples that are in your head. You know, if you created a standalone trust where the government is the only member, let's call it member of the trust, has established the trust, then that's going to be a fiduciary activity. And then it's just a matter of determining which fund type. So hopefully when we get into the CCMA white paper Q&A part, that'll help clarify this a little bit more. And if not, we can always circle back.
Okay, thank you.
Mm-hmm. So once you've gone through those determinations to determine which bucket and whether something is a fiduciary activity or not, then you have to take the next step to figure out what fiduciary fund type it will be reported in. There are two different main components of fiduciary funds. So my old acronym from back when I had to study for the CPA exam will not work anymore. Remember what fiduciary funds, which was fiduciary, agency, and trust, is now fiduciary, trust funds, and custodial funds. So agency funds will be no more. So you have 4 types of trust funds, which are pension or OPEB, pension or other employee benefit plans, investment, and private purpose. So your pension or OPEB plans are any that are administered through a trust that meets the criteria of paragraph 3 of 67 and 74 to meet that trust criteria, which we'll go over that a little bit later. Or other employee benefit plans for which resources are held in the trust that meets the criteria of paragraph 11C1 of Statement 84, 11C1 and 2 of Statement 84. And then the contributions and earnings to those types of plans have to be irrevocable. Then an investment trust is if you have it's the external portion of an investment pool that individual investment accounts that are held in trust. Then the fourth type is private purpose trust funds. So that's all fiduciary activities that are not required to be reported in the other the other trust funds. So it's kind of the all other account when it comes to trust funds. And then custodial funds. Custodial funds are now replacing agency funds, but they're not quite the same because, again, you might have some agency funds today that are not going to meet the criteria to be reported as custodial funds as we go through those. And we'll go through those when we go through the CCMA white paper. Mm-hmm. So custodial, they're not required to be reported in. It's the last bucket. If it's not a trust fund, then but it's still a fiduciary activity, then it becomes a custodial fund. So one. I don't personally have any clients that have investment trust funds. It's more common to have external investment pools at the county level, but I'm sure there's some governments that are listing today that do have external investment trusts. So if you have an external portion of an investment pool that is not held in a trust that meets the criteria of paragraph 11C1 of Statement 84, it should be reported in a separate external investment pool fund column under the custodial fund classification. So if you look at GASB 84, I should have included a snip here of it, but I didn't. So you can see you actually, because if you think of your front financial statements where all the funds are consolidated on the fiduciary fund statement, where you have your funds totaled up in columns by by type, you would have custodial funds and it would have two columns instead of one column for custodial funds. You would actually have two, one for external investment pool and one for all other custodial funds. And then there is an exception to BTAs, business type activities. So business type activities, which includes those entities where that is your only function, you only have a business type business type activities. It also includes enterprise funds for other entities. If the option is selected, there's an exception of that the corresponding liability for assets that are expected to be held upon receipt, if they're expected to be held for 3 months or less, then you can, rather than, if normally those assets should be in a custodial fund, they can actually be reported in the business type activity. So in the enterprise fund as asset with an offsetting liability. If you take that option, so that is an option rather than setting up a custodial fund. If you take that option, then on the statement of cash flows, if the activity for those assets and liabilities are significant or is significant, then you have to have separate additions and deductions as cash flows and outflows in the operating activities category of the statement of cash flows. That was a very confusing sentence. It's just telling you if the activity is, it's expected to be held 3 months or less, but it's a significant activity, because normally the assets and liabilities would just wash. You would see no income statement impact. You actually have to break it out in the statement of cash flow. That's what I'm trying to say. All right. Oops, did I skip a slide? I did. All right. So the presentation in the financial statement. So now you're going to have a statement of fiduciary net position and a statement of changes in fiduciary net position. So the statement of fiduciary net position includes all the assets, deferred outflows, liabilities, deferred inflows, and fiduciary net position of the fiduciary funds. Except one little caveat is that pension and OPEB activities still report in accordance with statements 67 and 74 as far as line items and reporting requirements. But all the other funds are going to report a liability to the beneficiaries when they call it a compelling event has occurred or no further action is required to be taken to release the assets. So if you're holding the assets on behalf of a third party or another entity, and really those assets can be released to the entity at any time, then you record the assets are offset with a liability rather than being offset with net position or fund balance, if it's easier for you to understand. Then you notice that there's a statement of changes in fiduciary net position. That is now required for custodial funds. So agency funds, you always only have a balance sheet, right? Now they're going to have an income statement. Custodial funds are now going to report an income statement as well. So in the statement of fiduciary net position, you're going to have separate display of investment earnings, investment costs, and net investment earnings. For those of you that have pension or OPEB trust funds in your financial statements, that's not something new. You've seen that. That's a reporting requirement that already exists. Well, now it's going to be required of all fiduciary funds. Custodial funds can aggregate separately, so you're not aggregating additions and deductions together, but separately aggregate additions and deductions of resources if upon receipt, again, that they're expected to be held 3 months or less. So additions can all be, but the description should still be relatively descriptive on the income statement. And then again, pension and OPEB, any additional requirements are reported in accordance with 67 or 74. So some of you, I have some clients where your agency funds only have balance sheet accounts. So that's something you want to start looking forward to. You're going to have to program your general ledger to include income statement accounts for your I keep calling them agency funds, for your custodial funds. So GASB Statement 97. So again, it was issued in June of 2020. So it's just hot off the presses-ish. And the paragraphs 4 and 5 are effective immediately. So paragraph 4 is related to the absence of a governing board. It's to, when you're doing those component unit determinations of whether an activity is a component unit or not, one of the criteria is to, who's on the governing board, who has the voting majority of the governing board. When you have the voting majority of the governing board, it makes the decisions on whether it's a component unit much easier. Well, if there is no governing board, what does that mean? And so Statement 97 clarifies that a government is financially accountable to a component unit if the government performs the duties that a governing board typically would perform. If there is no identified governing board, then you still might, if you have, if you perform those duties, it's the equivalent. So it does not, however, apply to the potential component units that are defined contribution plans or OPEB or other employee benefit plans. So defined contribution plans, this criteria doesn't apply. And then paragraph 5 is the applicability of financial burden criterion of paragraph 7 of Statement 84. So it's applicable only to defined benefit, pension, and OPEB plans. Again, doesn't apply to defined contribution plans. So I've rattled through that pretty quickly, and we're going to get to polling question number 1. Let's see if we can get this here. All right, here we go. So polling question number 1, do you plan to early implement the provisions of Statement 84 in fiscal year 2020? Just curious, because some people might have been all ready to implement. So we'll give you a few minutes. Or a few seconds, or 30 seconds.
What are you seeing in your clients, Amy? Do you see a trend?
I think if it's funny because the answers, like with anybody else, the answer would have been, even 3 months ago, probably would have been, yes, we're going to move forward with it anyway, even with 95 being implemented. But now that things are still stretching out and shelter in place is extending on, that the answer has been no so far.
Oh, yeah, that makes sense.
Yeah, and I don't think I said it on one of the earlier slides. I'm going to share the results now. That it's an all or nothing. If you decide to early implement 84, you can't just implement bits and pieces of it. It's the whole, so you have to implement the whole Statement 84, and then you want to think about looking forward to anything else that comes, there's a few provisions in Statement 97 that aren't applicable till 2022. Do you need to look at those and early implement them? So you can see from the polling results that the no's prevail. Yes, no, not sure. And but there are still, I'm not sure, because for some entities, it may be a really easy answer. You may only have agency funds to worry about and no other activities that could be fiduciary. So it might be a relatively simple implementation and get it out of the way to give you some more breathing room before leases come along. All right. There we go. Did I just close it? Okay. All right, so now we're going to go over CCMA white paper. Catherine had mentioned the CCMA because Catherine and I are members of the California CPA committee. Wow, Governmental Auditing Committee. And wow, I can't even say it now, Catherine. We call the GAC, Governmental Accounting and Auditing Committee of the Cal CPA. And that committee, along with the League of California Cities, it's a joint effort. Together is the CCMA, the California Committee on Municipal Accounting. So that promotes sound accounting and auditing procedures to improve the quality of reporting by municipalities. So the CCMA issues white papers for California's specific implications such as redevelopment agency dissolution. So many of you are probably familiar with those CCMA white papers. One of my favorite, you know, I'm an accounting nerd or auditing nerd, the old GASB 34, how to present the revenues. I call it the GASB 34 cheat sheet for the statement of activities. That was an old CCMA white paper that's still out there and is still pretty valid. It needs to be updated, and our group is working on it. So the white paper, this white paper was issued on March 31st, 2020, just a little prior to the issuance of GASB Statement 95 that extended the implementation dates to 2021. So that's why you'll see, if you look at the white paper, which I hope you will look at the white paper to start with your implementation, the dates are off in that statement. So we don't feel a need at the moment to amend it because we'll just do that if the decisions change, but the answers aren't different. It's just the implementation period. So the white paper has 8 sections. You can see the ones that I've expanded off to the left. Introduction and Q&A are the 2 we're going to go over right now. The other sections, great read through. There's a good overview. It also includes the flowcharts the flowcharts are from the GASB statement, so they're not as clear in our white paper, but so you want to go to the GASB, but it's good. There's a walkthrough of flowcharts to help you make the determination of whether something's a fiduciary activity. I did not try to include it in the presentation today because it's a lot of detailed information and it's too hard to follow it on this small screen, so you're better off looking at it where you can expand it out. All right, so I do have to say the CCMA white paper, it was also issued prior to the issuance of 97, but our group, when we were drafting the white paper, was aware of the expected information included in the statement. So our conclusion coincides with what was in paragraphs 4 and 5 in 97. We have inside information. So the introduction to the white paper, scope and limitation, it summarizes, does not include all the information contained in statement 84 or the implementation guide. And of course, we have to give a disclaimer. The white paper is not authoritative guidance, and the views expressed in the white paper are not the official positions of GASB, the AICPA, CalCPA, or the League of California Cities. And then, so in the purpose, it says that the purpose of it is to clarify and interpret the standards for California's state and local governments. So the Q&A section of the statement is comprised of 5 sections. And if any of you saw my presentation at CMFO earlier this year, that presentation was based on a draft of the white paper. So there were some changes, including changing references to OPEB and pension trusts. We changed them to plans, which I'll go over in a minute, and removing section 6 that didn't include California specific information. So again, we try to keep it focused on California specific with a few exceptions we'll talk about. When something's in the GASB Q&A, we don't need to say it again in the white paper, so we try to just talk about the specific items. So Q&A section 1. So in these, I've got all the questions here on the next 2 slides, or 3 slides. So there are 7 questions in section 1, but the bold questions are the ones I'm going to dig into. But of course, I do encourage you to look at the full white paper and read through it, and especially the Q&A. And at the end of this slide presentation, which you now have, there's a link to find the full white paper. So, so that you can see these questions here. And let's see. So we're going to go over, I said 7 questions. Sorry, 1 went away. There's 6 questions. And we're going to go over 3 of them. Whoops, sorry, I'm going the wrong way. Okay. Oh my goodness, sorry, I'm going all over the place now. Here we go. Okay, now we're gonna get into the 3 questions. Hopefully I'm not getting you seasick going back and forth. So question 1.02 is related to, so section 1 is related to successor agencies. So even though it's old news, we know it's old news, we wanted to make sure that there was still some clarification because the CCMA had issued the prior white paper on redevelopment agency dissolution reporting, accounting and reporting, and wanted to make sure that the conclusions in that white paper didn't change with the issuance of 84. Does it make sense to still report the successor agency in the private purpose trust fund? And so the first question is just about, in the state dissolution statutes, what body is identified as the governing board of the successor agency? As you know, Health and Safety Code doesn't explicitly identify a governing board, but effectively the oversight board fulfills that role. And then after 7118, that role is at the county level. You have the county level making these decisions as the oversight board, all subject to approval by the DOF of the ROPS activities. So question 1.05 is, should the assets held by a city on behalf of a successor agency be reported in a fiduciary fund of the city? So using the provisions of Statement 84, and you can see these bullet points here, the successor agent activities are fiduciary in nature. So the conclusion is yes. So it doesn't change anything. It stays as a fiduciary activity, doesn't move into the governmental activities of the city. It's not its own source revenues, beneficiary is not the city, and so forth. And then question 6, this is the one I know you're all on the edge of your seats waiting for the answer to this one. 1.06 is under Statement 84, how would the financial activity of the successor agency assets held by the city be presented in the city's financial statements? So the answer hasn't changed, thankfully. Still a private purpose trust fund. There was some discussion about whether it should potentially be a custodial fund. Does it make sense? But ultimately, when you go walk the path, the conclusion is private purpose trust fund. So there's no change needed in your presentation. So that's good. So section 2 is OPEB plans. Again, plans, not trust, and then deciding whether those OPEB plans are fiduciary activities. So it's a 3-step process to determine whether an OPEB plan is a fiduciary activity. Does the trust arrangement meet the criteria of paragraph 3 of GASB Statement 74? Is the OPEB plan a component unit? And then if it's not a component unit, does the employer control the assets as defined in Statement 84? So once you go through that process, then you determine whether or not it's a fiduciary activity. And so one important point that I mentioned earlier, and I said I would get to, is plan. So the plan, whether it be pension or OPEB, in this case, the OPEB plan. The OPEB plan encompasses the totality of the arrangement. If you have not established a trust, there is no plan. And that can get a little confusing because you think, oh, you've got this plan to disclose. You've set up benefits. You're providing benefits to retirees. You're going through this process, but you're saying, what do you mean I don't have a plan? You have a benefit arrangement. If there's no trust, there's no plan. So that's why when you're doing the assessment as to whether something's a component unit or not, you're looking at the plan as a whole, not just your benefit piece to it. And if a trust was established, regardless of whether the trust is used to pay benefits, then the OPEB plan as a whole is analyzed. And that's another confusing point because many of you have joined multiple employer trusts such as CERBT, and they might be used as an ultimate investment tool. You're putting aside assets, but not actually using that trust to pay benefits. But for this process, you have to look at, once you've established that trust, you've joined a plan, you're looking at the plan as a whole. I know it's a little confusing when you get through it, but hopefully as we go through the Q&A, it will help you understand a little bit. So in section 2, we focus on the California specific plans. So we're walking through that first part of the component unit determination for the 2 main California specific plans, which is CERBT and PARS. If your government has not established or joined an OPEB trust, then you only have to report the benefit arrangement under the provisions of Statement 5. There are no fiduciary activities. So you just stop there. You don't even, if you haven't joined a trust or established a trust, you just have a benefit arrangement and you're only reporting under 75. You don't have fiduciaries. I just said the same thing twice in a different term. So starting through those plans, CERBT or the CalPERS plan, you can see the conclusion on this slide is that the plan is not considered a fiduciary activity because that level is at the CERBT board. Do you have a voting majority of the trust board? It's not whether you can establish your own. You're the one, you as the government are establishing your benefit levels. You're making all these decisions on the day-to-day activities for the benefits, but the plan again includes the trust. So once it is put together, the answer is no, it's not a component unit, not a fiduciary activity. This doesn't, for most of you, I assume all of you in CERBT, doesn't change your reporting. You didn't report a fiduciary fund in your financial statements, up until 84, and you're not going to add it in after. Where the change is going to come in is the PARS plan. With PARS, you can see that the conclusion is that it is not a component unit and not a fiduciary activity. Again, you've joined an agent multiple employer plan, an agent multiple employer trust. Your assets are being pooled with others. The trust, you don't have control of the assets. You have control of making decisions on the benefits, but not the assets themselves. And so that's the level that the decision making takes place. And so this will be a change for many of you. that we'll discuss in a few slides, because in the past, the difference between CERBT and PARS was that CERBT, the decisions were made based on the plan administrator. CERBT said, we're the plan administrator, we'll do all the 74 reporting. PARS at one point said, no, we're not going to, you are the plan administrator, and we're not going to do that reporting. That's changed over time. They still say they're not the plan administrator, you are in the trust documents, but ultimately they are providing that statement 74 reporting, and you can see it doesn't meet the criteria. When you look at the plan as a whole, it doesn't meet the criteria for being a component unit or a fiduciary activity. Then the third type of trust that you could have is a standalone arrangement. If you have your own, if you've established your own trust arrangement, your assets are not pooled with anybody else, there are no other entities involved in your trust, then the answers, the yeses prevail. You can see legally separate, voting majority, yes, 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 yes. So that is a component unit and is considered a fiduciary activity. So this section only contains 2 questions just related to CERBT and PARS and whether or not they are considered, should be reported as a fiduciary fund. And the answer to CERBT is no. So the CERBT holds the investments in a multiple employer trust. It makes the investment decisions based on an investment strategy selected by you, the government. The government determines the amount of contributions, if any, to the trust, and distribution of trust assets. You can decide when your assets go to the beneficiaries or get used in some manner. And there has been some confusion about that arrangement. Again, because some governments make deposits with CERBT and then do not touch the assets. From then on, continuing to make pay-as-you-go contributions. So you think you have control over the activities, I'll call it. And so, and even as the auditor, we think of that as the plan, but it's not. That GASB's, the plan encompasses the whole arrangement, including a trust. If there's no trust, it's just a benefit arrangement. Once you join the trust, it changes everything, and you have this full plan that you have to look at. And so, if you have established that trust that meets the criteria in Statement 74 to be called a trust, or excuse me, the trust criteria in Statement 74, that means there's a plan, determinations at that level. Without it, you just disclose items and report your net OPEB liability. You don't have fiduciary activities. And so that's this case. PARS, the next slide, it's not moving, there we go. So PARS arrangement, again, it's the same. It's similar to CERBT. PARS holds the investments in the multiple employer trust, makes the investment decisions based on the strategy selected. You just determine the amount of contributions. It's administered by PARS, even though PARS says the government is the plan administrator. That assessment is at the plan level, and you can see that the conclusion is no, it's not a fiduciary activity. So this is going to change. Many of you, I know a lot of my clients, this is going to be a change for them, where we reported the clients reported a trust fund for PARS because of that distinction with PARS saying they weren't going to provide some of the reporting information. But you don't have to make these changes until you implement Statement 84. So Section 3, same process, but for pension plans. Again, the 3-step process to determine, sorry, the highlighter keeps popping up in the middle of the screen. I don't know how to get rid of it. There we go.
Amy, there's a question. So when
Sure.
you're at a good stopping point.
Sure.
Oh, ask now?
Yep.
Okay. So if I have a Section 115 fund for pension liabilities and I currently hold it as a general fund reserve, I think, does this mean based on GASB 84, it has to now be a fiduciary activity?
I will answer no, and there is a slide about that in about 3 or 4 slides. So we're going to there's a perfect Q&A about that in the white paper that we'll go over in a minute.
Okay.
Yeah, perfect. Yeah, so ultimately the answer is no, because does it change that decision? So the decision for pension plans, again, it's that same 3-step process. You're looking at the totality of the arrangement. There's not a whole lot of change in your current reporting, but still you want to be looking at things just to make sure you don't have any unusual situations or pension benefits that need to be looked at again. So your California specific plans include, of course, any single employer plans. There are a lot of single employer pension plans where you've established your own trust. And then agent multiple employer plans or cost sharing plans through CalPERS or the county, PARS, and then there's also a defined contribution plans could be considered agent multiple employer plans. So for a single employer plan, if a government has established a standalone pension trust, then as you can see, the yeses prevail and the pension plan is a fiduciary component unit and should be reported as a fiduciary activity. If you're in CalPERS or a county pension plan, you can see that those plans are not component units. You see we've got yeses and nos on the answers here, but not considered a component unit, not a fiduciary activity. You don't have that voting majority, don't have control of the assets. You're joining a agent multiple employer plan. PARS trust, same conclusion. Again, you're joining a multiple employer plan, and so that changes. This is when we're trying to determine if it's a component unit. And then for defined contribution 401A plans, would those be considered a component unit? And the answer is no. Again, because you don't have a voting majority of the trust board, that financial benefit, burden, or imposition of will and fiscal dependency is a yes, no. You might have financial benefit or burden, but can't impose will or fiscal dependency on the plan and don't have control of the assets. And then something to start thinking about, it's something I'm not going over today because I'm still trying to process exactly what it means as well, but it's another provision of Statement 97 that's effective in fiscal 2022 is related to Section 457 plans. So Section 457, your deferred comp plans, if you remember years ago where those came off the books, they used to be in agency funds, they came off the books when an Internal Revenue Code provision changed. So if a Section 457 plan meets the definition of a pension plan or an other employee benefit plan, then it might be considered a pension. Wow, I just said it. Sorry. If it meets the definition of a pension plan or employee benefit plan, then you have to do the provision. You have to look at them and see if the provisions of Statement 84 need to be applied, and the arrangement should be reported as a fiduciary activity. Some are probably going to still be considered a defined contribution plan, so might not be considered a component unit, but you need to start analyzing those 457 plans in conjunction with the implementation of Statement 97 in 2 years. So the questions in Section 3, there are 2 questions, so we're going to discuss both of them. The next slide is another one of those very busy ones. So for those of you that have established, here's the question that was asked, Catherine. So for those of you that have established a secondary pension trust, so we always call it Trust A, Trust B. Trust A is your main primary pension trust, the one that's paying the benefits on the day-to-day basis to the retirees. And if you've established a secondary trust, Trust B, through PARS, or I understand CalPERS, I think they're now, I know they started and then stopped, but I think they're now offering that option to set up that secondary trust. The first question for that secondary trust is to see if, this question is to see whether the prior GASB guidance has affected the provisions, is affected by the provisions of Statement 84. And fortunately, the answer is, or unfortunately, I should say, unfortunately for you, the answer is no. The conclusion, GASB 84 does not change the reporting. Sorry, fortunately, no. Unfortunately for you, it will still remain in, if it's in the general fund today, it's going to stay in the general fund after you implement Statement 84. Because the caveat, the nuance is that secondary trust, in order to be considered a trust that meets the criteria of paragraph 3 in Statement 67, the trust has to be for the benefit, to pay benefits make payments to the beneficiaries. Most of these secondary trusts, or all of them that I've seen, they are only to make payments to Trust A. So Trust B, the purpose is to transfer assets to Trust A or to the government to reimburse it for its costs. It's not going to beneficiaries. And so that's the nuance that makes it not a trust that meets the criteria. So it's not a fiduciary activity. It can't be used to offset the pension liability, so it stays in your general fund or whatever fund made the contributions. Sorry.
Okay, one more question, Amy.
Sure.
For 457 or 401 defined contribution plans, I understand it is not a fiduciary fund because it does not meet the definition of a pension plan. But the question is, where, if anywhere, do these funds get reported? Do they get reported at all? They are not a component unit.
So if it doesn't meet the component unit criteria, but it is considered, if ultimately when you walk the path, it is considered a pension plan. And if it's a defined contribution pension plan, then the defined contribution reporting requirements would be, so there's no fund in the financial statements, but there'll be additional information included in the note disclosure, which is the required contributions, what the contributions are, the benefit levels, if that applies. So those need to be analyzed under the provisions of Statement 97, looking at it that way. Mm-hmm.
Okay, thank you.
Mm-hmm. So the second question in section 3 is if a government has a single employer supplemental plan administered through PARS or another trustee. So don't forget your other little pension plans that might be those, you think of them as just that little plan, as I call it, but they could have significant assets accumulated that need to be reported as a fiduciary activity. So if you've established a pension trust administered through PARS or another trustee that is not a multiple employer trust, it's a standalone trust or plan, then you need to use, using the criterion statement at 84, it is most likely, depending on the circumstances for your government, but most likely a fiduciary component unit that needs to be reported. And that might be a change for some entities. So section 4 is about investment trust funds. Unless there are some specific questions, I'm going to kind of breeze through this a little bit because they're not all that common, but there are 2 questions in this section just related to how to report it. If you manage the investments, how do you report it? It's a custodial fund, or it's funny, both questions, the answer is the same, custodial, but maybe investment trust. So it depends on how the assets are actually held. If they're held in a trust that meets the arrangement in paragraph 11C1 of Statement 84, and same with question, the question 2 is the same. And so, because there could be, sometimes there are voluntary and involuntary participants in a county pool. Does that change the answer? And it doesn't change the answer if there are involuntary participants. And for those of you that might not know what those are, sometimes the county will hold assets, like things like property taxes, before it distributes those to other agencies. It might be in a custodial fund of the by default, you're involuntary a member. Wow, I can't talk all of a sudden. You're involuntarily a member of the county pool, and does that change the answer? It doesn't from the county side. So next is polling question number 2. I'm sorry, we're not stopping for a coffee break, even though it does look good, doesn't it?
Okay, there's also a question.
Sure.
Do you want to go through the polling question first? Or what would you like to do?
I can hit the question. Let's do the question first.
Okay. A lot of munis used the trust and agency funds for payroll clearing accounts and other third-party money that was for specific purposes, but too small for a special revenue fund. This draft means those would all go away, right? Basically would be in your general fund or special revenue fund.
Agreed. Yes, we'll talk about that when we get to section 5, because that's kind of the hodgepodge of all the remaining questions for other activities. Agreed. Mm-hmm. Yes. Yeah, I'll go over that in a second. Perfect. It's like they're forecasting my slideshow.
I know. Did you pay them, Amy?
I did. Gotta get the right. Thank you, whoever you are. All right. So question 2 is, so now that you've heard all my ramblings so far on the white paper, even though we have one more section to go through, does your answer to early implementation change after you've seen most of the CCMA white paper? We'll see if those 10 people that we're going to early implement still yet. See, it's still that same 10. Good for you. Oh, more early implementers. Oops. All right. So share the results. So you can see the majority, the same 59, absolutely not early implementing. I don't blame you. There are a lot of little nuances to think about, and this gives you more time to do so. But a few of you might consider early implementing. That's good. just to get it out of the way, and then the unsure. And the number, if I remember right, the number to early implement increased, so that's good. Okay. All right, then section 5 is other fiduciary activities. So section 5 has 13 questions. We're only going to talk about 2 of them. Just go quickly over. I'm just going to breeze through these slides quickly here because you can look at the white paper and read the questions, and you also have the handout from today. And you can see that the first question is 5.01 is about SB 1186 that requires governments to collect $4 from businesses via business license collections. Cities to use $3 to promote local activities related to disabled persons, and $1 is to be remitted to the state. Is that a fiduciary activity? And although it might appear to be an imposed activity that might make sense when you look at it to be a fiduciary, and you might think about putting in an agency fund right now, the answer is actually no, because it's an exchange-like transaction from the city's own source revenue. The city is imposing the business license taxes. The state's just doing this add-on. And the city can control the use of those assets. The city, although the state says that it's restricted to this purpose, the city can actually say what it's going to be used on specifically. There's not you making your own decisions on the type of activities related to disabled persons. And so that ability, although restricted, the $1 is a deposit payable to or liability until remitted to the county, but the $3 is an own source revenue, restricted revenue. And then here's the answer to the payroll clearing fund. So many of you out there have those clearing funds that are currently reported as agency funds. Very common. This is your fair warning that those are going to go away. So they are not going to continue because, as you can see on this slide, the assets don't meet all of the criteria in paragraph 11 of 84. And the tax and payroll liabilities are the liabilities of the government. So even though they're out there and you don't want to show huge liabilities, just because it's that timing of the end of the fiscal year and whether payroll went out or not, it is your liability. And so it will become, most payroll liabilities we would assume become into the governmental fund, but if you do your allocations, it might be spread out depending on how you do your year-end payroll accrual. So it'll need to move into that fund. And then although this question was not really a California specific topic, even though I kept saying that CCMA is about the California specific items, our group thought it was important to include this question just because they're so common among a lot of our clients. And also, if you look back on if you have the slides in front of you, you'll notice there is a question about deposits payable, because that's another common agency fund. Contractor deposits payable are often an agency fund rather than the general fund or a special revenue fund. Those are not going to meet the criteria to be included as an agency fund either. And so those will have to be moved into, or I said agency fund, not meet the criteria to be a custodial fund. So those will move off into a governmental fund or, whatever fund type is applicable, but they will not be fiduciary. So,
okay, we have another question, Amy.
Perfect.
Okay, yes, a consolidated bank account used to pay agency and trust vendor bills considered custodial. And does the cash flow and outflow, does the cash inflow and outflow need to be reported on the agency cash flow statements?
So thankfully, there's no cash flow. If you're talking about, custodial funds are only going to report a balance sheet and an income statement, or a statement of fiduciary net position and a statement of changes in fiduciary net position. They won't report a statement of cash flows. But if you just meant about how to report those inflows and outflows on the statement, yes, they will be reported there. But you can aggregate them if they're to be held for 3 months or less. If they're not, then they're going to be broken out into, like a normal income statement, what the main sources of revenue and expenditures are. I hope that answers the question.
Yeah.
Okay. If not, we can circle back.
I wonder if it is I wonder if the first word is supposed to be, does a consolidated bank account used to pay agency and trust vendor bills consider custodial? Maybe that was the first part of the question.
Yeah, because the bank account itself doesn't dictate it. It's that whole arrangement. What is it? Because you might not even have a separate bank account. It might be in the normal general checking account, but you have a separate fund to account for these activities that are for this third party. So It's a matter of looking at the full of the arrangement and what is the restriction on the use of the assets.
Okay,
All
thank
right.
you.
So now we're going to transition into leases. So statement 87, and of course I talked way too long on GASB 84, but you know how our presentations always go, this, because now that leases isn't to be implemented until 2022, this is that fair warning of what you need to do on the front end to start to get ready. And you'll hear this from us again for the next 2 years, this presentation, and we'll keep adding more information as it gets closer. And something I did for another group that was a presentation just on leases is we actually did some exercises. So that's something that we could think about doing in the future. Maybe, this, like the how-to, getting that information going so you know exactly what you need to do. So under the previous guidance for leases, which was GASB Statement 15, the leases were classified as either capital or operating, depending on whether the lease met any of 4 tests. So in many cases, the previous guidance resulted in reporting lease transactions differently from similar non-lease financing transactions. So this brings GASB in line with this new statement 87, brings GASB in line. I say new statement. It was issued in 2017, so it's been around for a while now. They give you fair warning, and then now it's even been pushed out farther, which is good. But it brings GASB in line with FASB lease accounting requirements, which I believe FASB also extended the implementation date for their leases statement. So this will include all lease transactions. So it's operating capital. They no longer have that description or distinction between whether something is operating or capital. And so Statement 87 defines a lease as a contract that conveys the right to use the non-financial asset for the period of time in exchange or an exchange-like transaction. So the overall determination as to whether something it falls into a lease arrangement depends on the contract, whether it conveys the control of the right to use the underlying asset, such as the right to obtain the present service, these terms, present service capacity from the use of the underlying assets as specified in the contract, and the right to determine the nature and manner of use of the underlying assets. So once you have that arrangement, then it's going to fall into needing to be reported, and accounted for under Statement 87. And so the only distinction of leases, again, operating capital goes away, but now they become long-term or short-term. Short-term is 12 months or less, including any periods that include an option to extend the lease. Anything that's 12 months or less, including the option period, is considered a short-term lease and doesn't have to be reported in this manner as far as recording an asset or liability. So then it's long-term assets, long-term leases that are subject to the provisions. So the biggest question we usually get, copy machine leases, do those fall into this guideline? It could be, if you have a long-term copy machine lease and it's material, if the payments are a material, that's what you want to consider. We've talked about materiality should be taken into consideration. It wouldn't include the supplies component. So sometimes those copy machines, you have this lease payment that includes the purchase of or the use of the copy machine, but then that payment also includes the materials or supplies, the toner, sometimes even paper. Those components of the payment are not included in this, in the calculation, because those are, what's the word? Not expendable, usable. I can't think of the word I'm thinking of, but usable components. So it's just the lease, the lease of the machine itself. That's considered where you look at materiality. And so something that you want to think about is setting a capitalization threshold, or a threshold of what you're going to determine whether a lease meets the need to be reported whether the lease meets the determination to be reported as a lease. Well, you know what I mean, if it's considered a long-term lease. So some building agreements, some leases for buildings may fall into this guideline. Now, if they're those dollar type of lease arrangements, you're leasing a building to an entity, or you're the one leasing the building from an entity for $1 a month or $1 a year, those don't qualify because they don't meet the threshold of an exchange or exchange-like transaction. You're not getting equal give and take. $1 for a building is not equal exchange for the use. Then other exclusions. There are some exclusions and arrangements that are excluded from this lease statement, or this statement, which includes leases for intangible assets, biological assets, inventory, contracts that are under the definition of a service concession arrangement, and supply contracts, such as an agreement to purchase power. Those aren't considered leases in this definition. So once you've determined whether something, after you've determined whether an agreement is a long-term lease as defined in the statement, then the accounting begins. That's where we start the accounting. So the lessee is going to book the lease liability offset with an intangible asset. They will equal each other at the start. So at the commencement of the lease liability equals the lease asset. Then you amortize that, the payments over the life of the asset or the lease terms, whichever is shorter. So if the asset has a 5-year life, but the lease has a 10-year life, you're going to amortize it over the 5 years. And then the disclosures are very similar to the current capital lease disclosure requirements. So the disclosures themselves are not going to be anything too unusual. There's a few components that you may have to add, but it's not anything you're not used to, that you're not already used to disclosing if you have capital leases. So the leases, the accounting for the lessor. So for those of you who've been trying to avoid learning about deferred outflows and inflows, you can no longer resist. If you have long-term leases, you're going to have to. I mean, I'm sure most of you with pension and OPEB, you're very familiar, but you think of that only at the entity-wide level, maybe in the enterprise funds, and you can kind of avoid it at the fund level. And I just said fund level, but I realize this is long-term leases. So a lot of this is going to be at the entity-wide level and not in the funds either, but it might be in some of your enterprise funds. So, so the lessor, you're going to continue to depreciate the asset. So even now, though you have this asset that you're leasing to someone else, you're going to continue to have that. You're not going to retire the asset that's being leased unless there's a requirement for the lessee to return the asset at the same or better condition. So those are some provisions in the statement. And you're going to record keep the asset and then book a lease receivable offset with a deferred inflow. So that means you'll still have the asset on the books and continue depreciating it, but then you're going to have this lease receivable offset with a deferred inflow. As the payments are received, the lease asset should be amortized, and GASB loves to use the term in a systematic and rational manner over the shorter of the lease term or the useful life of the underlying asset. Of course, you can do straight line, but if you want to do something more complex, it just needs to be a systematic and rational manner. However you would like to define that, you can look at the GASB statements for some information. Then the amortization of the asset, the lease asset, should be reported as the inflow of resources. So notice that GASB has, they're not using the terms revenue or expense or expenditures anymore. They're preparing us for the future reporting model changes that are going to change the income statement to be a statement of inflows and outflows of resources rather than revenues and expenditures. So, but that's what it means. When they use the word inflows, under today's accounting, it means revenue, outflows, expense. And then the disclosures that are required include minimum lease revenue amounts due and the amount of revenue received, because sometimes you have that minimum amount due, but then what was actually received, because there could be other components to the receipt. So some other considerations, if you have contracts with multiple components and contract combinations, you have to treat them as separate leases and look at them separately. Any sales leasebacks, there has to be it's required to have a qualifying sale, otherwise it's just considered a borrowing. And they're accounted for if there are sales and leasebacks, they're accounted for in 2 separate transactions, the sale transaction and then also the lease transaction. And then you have to, of course, disclose the terms of the lease arrangement. And then Statement 87 includes separate guidance for any leases with or between blended component units. It's considered internal leasing activity, well, not considered. Any internal leasing activity is eliminated when the financial statements, in the combined financial statements, just like when you have financing authorities where you eliminate that lease receivable and the lease payable, because when it's blended together, you have debt and cash on the hand. You don't have that, but when it's if there are separate financial statements, you may have to report the lease information and gross. If that makes sense.
Okay, Amy, there's a question.
Sure.
What about cell tower leases? We're just really renting air to them. We don't own the tower.
So there is a Q&A, and I didn't think to include it in this presentation, and I don't have the number offhand, but there is a specific Q&A in the implementation guide that covers cell towers, because again, you have to look at materiality, because really, if it's long-term, if it's a long-term arrangement, it definitely is a lease, but then you have to look at materiality what is exactly being leased. Because you're right, you're leasing, if you're leasing an intangible item and not the piece of land or the piece of the building, you know, then it doesn't qualify. If you saw, that was one of the exceptions, is intangible assets. But you have to look at actually what the agreement says is being leased. It's the right to use that portion of the building if the tower is on the side of a building, or if it's on a parcel of land that you've leased, it might qualify. So you have to look at that specifically.
Okay.
So leases, there could be modifications and terminations along the way. Those come from amendments to the lease contract, from exercising options in the contract. Something's considered a lease modification unless the lessee's right to use the underlying asset decreases. If it increases, it's a lease modification. If it goes down, it might not be considered a modification. So terminations, there could be full or partial lease terminations if the right to the underlying if the right to use the underlying asset decreases, it could be considered a termination. And you might have to report, you know, once there's a modification, you may have to report something as a new lease by both the lessor and lessee if there are new assets added, or if it's what's called not reasonably priced. That's the term GASB uses. Otherwise, you have to remeasure the lease. And we're going to go over an example in a few slides of, I want to make sure I get to that slide so we can talk about how you measure the asset and liability. So I may skip a couple of slides or breeze through them. So if you do have to remeasure, you have to remeasure the liability on the effective date of the modification. You adjust the rate of use asset to the new revised amount. And then if the change results from the lessor refunding related debt, it could be, and passing the savings on to the lessee. I don't know how common that is. So there's separate guidance in the statement. And for any terminations, any partial or full terminations, if the lessee reduces or removes the asset or obligation, if it is terminated, it goes away. And then you recognize the difference as a gain or loss. So once you've had that termination, you have to account for it. It's going to go away. Then the difference between what's going away is a gain or loss, depending on, because what am I trying to say? Because at the beginning of the period, the amounts agree, but then the amortization, if you saw earlier, which we'll talk about in a minute, they're not equal. So the difference, once you take it off the books, would be a gain or loss, depending on which direction it goes. And then if a lessee purchases the asset, you would have to reclassify it to the appropriate asset class. It's no longer going to be related to the lease. It might be a capital asset. So one of the most important terms, we talk about whether something's a short-term or long-term lease. Well, in order to determine that, you have to determine the lease. What is the lease term? The lease term is the non-cancelable period. And again, I didn't say that earlier. The leases, if any lease is cancelable, then it doesn't qualify as a long-term or short-term. It's just a lease. It's not a long-term lease to disclose in this manner or record an asset if it's cancelable. It's only the non-cancelable period, I can't say that word anymore, plus any periods covered by any options to extend. You notice it's lessee, lessee, lessor, lessor. So any option to extend or option to terminate. That's the main component. And you notice this key, you're going to see it on the next few slides. You have to be reasonably certain the event will occur. If you're reasonably certain that the lessee is going to extend the lease, then that becomes part of the lease term. If you're not sure whether you're going to extend the lease at the end, then it is not part of the lease term. So that's the key point, reasonably certain. So that's not defined by, so it's like more certain than not, right? It's not going to be defined by GASB, but it's whether you're reasonably certain. It doesn't have to be perfect. Things can change along the way, but it's something you need to analyze. So if a lease includes an option for one side to terminate the lease without the permission of the other party at any time period covered by that option, then it's not included in the lease term. And then also some leases include fiscal funding clauses, such as, like if you have it's one of the provisions says the agency will annually budget the lease payment. That's not included in the lease term. That's not, unless it's reasonably certain that the clause will be exercised. If you're reasonably certain that you're not going to budget for the lease payment, okay, then you need to look at whether that needs to be included or excluded from the lease term. So when to reassess the lease term? Each year, so once you've implemented 87, once you're there, right, in 2022, or early if you decide to, each year or more often, depending on how your government will be accounting for leases, whether you do it quarterly, monthly, daily, probably very rare. So throughout the fiscal year, leases should be analyzed to determine if there have been any events that would trigger the need to reassess the lease term. And that's what you need to look through. So any options that are elected, anything that changing, if you're reasonably certain decisions in the past changed, or if the lease was amended. So again, we talked about short-term leases, 12 months or less, including any option to extend, regardless of the probability. It doesn't matter. If the period is 12 months or less, then it's short-term. Okay? And so it's not subject to this accounting. So leases. So for the lessee calculates the lease liability at the present value of payments less any lease incentives. You know, I said you wanted to avoid deferred inflows and outflows. Now you have to remember how to do present value. Thank goodness for Excel. We don't have to do it ourselves anymore. So as payments are made, the liability is decreased by the principal payment and interest is expensed. The next slide is going to show the detailed components of that lease liability. So again, at the beginning, they don't equal each other. Sorry, I'm getting ahead of myself. So the lease liability, again, for any of these, this long list of components, for any of them to be included, it has to be reasonably certain that the event will occur. The total liability is then discounted using the interest rate the lessor charges to the lessee, you know, in the agreement, which maybe the interest rate might be implicit. So if there's no explicit interest rate in the agreement, then it's the lessee's estimated incremental borrowing rate. So that means you might have to add, you know, if you haven't issued debt or any other leases or bank agreements recently, you might have to call a bank and find out what your borrowing rate is to use that, because you're required to discount the lease payments at that borrowing rate if it's not explicit. You're not required to apply the guidance for imputation of interest in paragraphs 173 to 87 of statement 62, but you can do so if you want to impute the interest rate that's in the agreement. So in the PDF of the slides, I noticed that the title of this particular slide, so slide 71, the PDF said this was lessor, but it should actually be lessee. So the lessee, the lease records that lease asset. The lease asset is the initial lease liability plus any, it has two, sorry, it's lease liability. I thought I had another typo, distracted me. So we've got the lease, calculation of the lease asset is the same as the lease liability with two additional components. Any payments made to the lessor on or before the commencement of the lease, less any incentives, plus certain direct costs. And so those direct costs, those include any ancillary charges necessary to place the asset into service. You know, delivery cost, installation costs, those things. So if you remember, you know, it's your normal capital asset accounting, any cost to put the asset in place. So the lessor calculates the lease receivable, which is based again on the present value of the payments, and then you reduce it for any payments made to the lessee, and then it's offsetting with the deferred inflow, which is equal to the lease receivable plus any payments received on or before the commencement, and then you amortize it for over the life of the lease, and then you can, again, as we talked about earlier, continue to depreciate the asset. So other factors that could affect the lease term include provisions that allow for termination of a lease due to purchase of the underlying asset, payment of all sums due, or any default on payments that are not considered termination options. So polling question number 3. Maybe. So this question is, the lease term includes the period covered by an option to extend if it is reasonably certain that the extension will occur for which of the following? The lessor, lessee, neither, both. I still have time to figure it out since implementation is 2 years away.
Oh, look at all those people.
I know.
Taking the last option.
Don't blame you. A few more seconds. All right. So the answer, so you can see, you can't see so share the results. So the answer is both. Yes. So it's that the lease term includes the period covered by an option if it's reasonably certain that the extension will occur for both the lessor or the lessee. But you're right, you still have time to figure it out. You don't have to have all of this memorized yet. We're still figuring it out. All right. So next we're going to get into disclosures. Maybe. Okay. So, the disclosures, again, very similar to capital asset or capital lease disclosures. The lessee has to disclose these items on the next 5 slides, which I'm kind of just going to go through again, primarily because you have time to figure this out. It's pretty straightforward. You think of your normal disclosures. What are the terms of the lease, the payments in the, excuse me, like the debt, the next 5 years, and the 5-year increments after that. So the amount of the lease assets, major class of underlying assets. So you have to break out that is one change in the capital asset footnote. Any assets that are leased have to be broken out separately from other capital assets in the capital asset footnote. And then any outflows of resources that have been recognized. And again, this is the lessee disclosures.
Okay, we have 2 questions, Amy.
Sure.
Okay, the first one, just curious what your thoughts are on franchise agreements.
My thoughts today, that's the first time I've had that question, and it's a really good question. So it's a matter of just looking at the terms of the agreement and analyzing it for what exactly is being, what is being leased in that. Does it fall into the rules? I think there is, I'm not absolutely positive, but I think there is a Q&A on it in the implementation guide that asks that question, but I might be thinking of something else. So I'm sorry, I don't have any good firm thoughts today on that one, but I will keep that in the back of my mind for the future. Yes. What's the second one?
Okay, is that any good software out there to generate the annual JVs, after all the information are input, similar to a fixed assets software?
I haven't heard about, I'm sure there were ones that do generate the JE. I have heard there are a lot of, I think if you Google it, because I have heard of some accounting firms that are creating software both to read the lease agreements, where there are these large entities, like at that county level where you have hundreds of leases in place and you don't have time to read all the leases and analyze them. There are software programs that will analyze the lease agreements and spit out whether it meets the criteria to be reported. And then, so I would assume that those programs also then have that other part too to help you with the accounting for it, but I can't speak to that as of today, but I know some are being developed.
Okay.
Great. So the lessee disclosures continue more. Any commitments under the leases before the lease term, components of any loss associated with the impairment of the asset. So if the asset is impaired, you have to disclose that. And I'm going to skip ahead because I want to make sure we get to the sample, and we're so close to it right now. So any additional disclosures for their sublease, sale, and lease transaction. The lessor disclosures, again, kind of that common sense, general description, amount of inflows of resources recognized during the year, because there's whole 6 slides here of the lease disclosures. Inflows recognized, any terms, conditions of any options that were, what are the terms, if there are options for termination, and then any additional disclosures, if applicable, including, any assets that are investments, certain regulated assets, and sublease transactions, and again, that sale and lease back. And then if your principal operations consist of leasing asset to other entities, there are additional disclosure requirements and schedules, so you want to look at that.
Okay.
That's your principal purpose. Go ahead.
We have a question. What do we do with variable items that may change month to month, such as leases of property where utilities are built? Or would this just cover the base rent of the lease only?
So it depends on how the components of the arrangement, how the wording in the lease agreement. But if there are variable components, some of the variable components are excluded, while some might be included. So you have to really look at it. And we'll go. I think there is one because it's kind of what is that word I'm looking for? Not usable. The ones that are the utilities don't add to the. It's like the toner and the paper in a copier lease. It's not part of, you're not leasing the actual asset. It's not the, and I'm still not going to come up with that word that I'm looking for. So yes, you have to look at it and see, and again, it's the reasonably certain for the variable components too, whether they're going to occur if it's that type of variable component. So some of you might have regulated leases. So certain leases are subject to external laws and regulations, like Department of Transportation and Federal Aviation Administration might regulate aviation leases between airports and air carriers. If any of you have that, there are separate disclosure requirements if that's applicable to you. Okay. Then, so something you want to do, to me, this is one of the most important ones, and I have 2 minutes, I'm not going to get there. Does it just stop right at 3:30, Catherine? Or do I keep talking for a few minutes?
Yeah, you can keep talking.
Hopefully.
It doesn't
Okay.
stop.
Okay.
People may start leaving, but
I
that's
understand
okay.
if they do. I just want to get to the example, and I rambled on too much. And,
that's okay.
Okay.
That's okay.
We're almost there. So the preparing for the implementation, this is kind of, those of you that are my clients, you've heard me saying this for, oh goodness, since 2017 when the statement was issued. You want to start inventorying your current agreements. And some of you might have started because implementation was going to be just a year or two away, and now it's a little further out there, so you might have stopped. But you want to start inventorying those agreements so you can make sure that everybody knows what you need to do and you're ready when implementation happens. Because again, you have to restate at the beginning of the fiscal year. So you have to be ready to know what your leases are in place. And maybe a lease isn't long-term at that point, because you don't have to record a lease. If it's a long-term lease, but there's only one more year left on the lease, it doesn't qualify if at that beginning, if that makes sense. So a good suggestion I've heard also is you want to set that materiality level. I mentioned it earlier, that what's the threshold at which you're going to record a lease. First do your full inventory, get everything. You want to know your whole population, your whole world. Then you look at each lease to determine whether it'll be subject to the reporting and accounting provisions of the statement. Are they material? Well, you have to determine that materiality threshold. Some have suggested using your current capitalization threshold. You've determined when something should be capitalized. You could apply the same rules to that, but it's not required. But you want to be consistent. You want to establish. You can't say we're going to record this one because we like it, and we're not going to record this one because it would be too complex. It doesn't work that way. You have to establish a threshold and materiality for that, and be consistent from agreement to agreement. So in your lease inventory, which leases, once you have that full inventory, which leases fall, which will still be in place during the implementation year. Some will expire before you get there, so you won't have to worry about those. But then you have to develop a process for what ones are going to be issued between now and then to make sure they get into your inventory. Then consider any terms and modifications along the way that might change your decision. That reasonably certain, have things changed along the way that now decisions are reasonably certain that you're going to exercise, so now it might fall into being applicable, or the opposite. Will there be any impact on debt covenants or fund balance policies with the addition of the liabilities? Does it impact anything? And then you want to implement a system of internal control related to leases. How decentralized is your contracting department? Do you know about all the leases? How are you going to figure out what's out there aside from asking your departments? There's other ways, in addition to asking the departments of what leases are out there, other ideas are to look at your rent expense and lease expense accounts, analyze those accounts to help you figure out what leases are out there that you don't know about today. And then prepare yourself for new agreements that are issued between now and then. So the GASB implementation guide, that's something you definitely, like I said, there's 77 new questions and answers. Obviously, any implementation guide, you don't have to read the whole thing because every question is not going to be applicable to your entity, but you want to look at it, see what questions are. Like I said, I know the cell phone tower lease question is in there, so you can find that one as well. So here's the example, and I know we're over time, so hopefully most of you will stay for the next just a few slides. We're almost there. So the example, now these assumptions, this is straight out of the GASB, but I wanted you to be able to see kind of that simple calculation without a lot of excess information. Here are the assumptions. This is a contract for equipment. It commenced on July 1, 22. We're going to say it's applicable now, right? It's a 60-month non-cancelable term. There is an option to extend an additional 24 months, but we're not sure if it's going to be extended. So we're going to say it's not reasonably certain. The lease may be continued after that point on a month-to-month basis. So that's considered the cancelable term. So it's not included in the lease term. The base monthly payment includes $1,000 is $1,000, which includes 200 use hours, and any excess hours of after the 200 hours are $5 each. $80 monthly payment for any repairs and maintenance, kind of your ancillary charges. 4% interest rate. This agreement, we're lucky enough for it to have an explicit interest rate. And then there's a separate contract for delivery and installation of the equipment. So the lease term that we're going to use for the example, or that GASB uses for the example, it's the non-cancelable term only, 60 months, because we're not sure if they're going to extend, right? So we're not reasonably certain. So you're not going to include any of those the other terms, not going to include the month to month because it's not enforceable. And so the lease term stays at the 60 months. So again, using Excel, our friend, to determine the discounted amount. So your initial measurement of the lease asset and the liability includes the base payment. So $54,480, which is the $60,000. I can't do my math anymore. $60,000 discounted at 4% is $54,480. Do you include the excess use charge? No, because the variable payments are based on future usage and excluded. So I think that's where we could probably include the definition of the utilities. You know, it's based on future usage. That's the component or the criteria to determine whether something is included or not. So utilities would not, because that's based on your future use of those utilities. It's not a flat amount. Repairs and maintenance, do you include those costs in the calculation of the liability? No, because any service non-lease components are excluded unless it's not practicable. They like that word. If it's not practicable to exclude those repairs and maintenance, if it's too embedded in the payment amounts or the dollar amounts and it's too hard to extract it, then you would include it. But otherwise you exclude it. So the initial value of the lease liability is $54,480. Then to figure out the lease asset, that receivable, or excuse me, the intangible, sorry, getting my lessor lessee mixed up. The initial value of the lease asset, that intangible asset you're going to record, includes the delivery and installation cost. So the asset, it's all the cost to get it in place. It's the discounted payments plus the delivery and installation cost. So it costs $55,980 to get it in place, and that's the asset. And so then you go from there. We made it to the end. So the last polling question is, see if any of you peruse the GASB website very often. Probably not. Probably not. How many pronouncements has GASB issued in calendar year 2020? It'll be interesting. You might be interested to know that in 2019, calendar year 2019, GASB issued one statement, which was kind of shocking to me too, because it feels like they're constantly issuing statements, but they only issued one in calendar 2019. So, and I can see a lot of you are still online. I appreciate it. Appreciate you hanging on here to the bitter end. We are at the end. Let's see. All right, so I will go just a couple more seconds. I think it stopped. All right. So I don't blame all of you that said you've lost count. I feel that way too. So GASB has actually issued 6 statements this calendar year. So most of you got it right. They've issued 6 statements and 1 implementation guide this year. And more are coming. You know, those exposure drafts are out there. More are coming. All right.
Well, it's only half year though.
Exactly. But they issued 1 in all of calendar 19. Oh.
So I think, you know, it's only half a year. So we still have, you know, 5.5 months. So.
Oh, agreed. But it's that whole, but wait, there's more. So any other questions? If not,
is there any other questions? Okay, well, you know where to find us if you have more questions, and we still have 2 classes on Friday. I hope we see you there. The survey, once you exit the Zoom, it should be directing you to the survey. If not, please email us and then we can send the survey to you. Well, Amy, thank you so much today for helping us to understand the Gatsby's in depth. And we hope to see you next year in person. Okay, thank you. Oh, wait, hold on. There are two. Wait, hold on. There's two Q&A. Oh, it's just saying thank you. Well, you're welcome.
No, thank you too.
Thank
you, everybody.
All right, take care,
Thumbs
everybody.
up to you too. Thank you.
Thank you. Bye-bye.